Okay, so in a world drowning in digital copies, what's that raw, unrepeatable magic of a live experience truly worth? And for the company that virtually owns these moments, Live Nation, can they keep their grip? Or are the drums of regulatory scrutiny about to signal a forced curtain call? We're going to dive deep today, and what we'll uncover is, frankly, a stark disconnect between how the market perceives Live Nation's power and what a fundamental look suggests, especially when their, immense business might be facing an existential legal threat. By the end of this deep dive, you understand why the stock is trading at such a significant premium despite some major underlying risks. Welcome to the deep dive, where we cut through the noise to get you well informed. Today, our focus is Live Nation Entertainment Inc., traded on the NYSE as LYV. Our mission here is to peel back the layers of this global leader in live experiences. We're drawing insights from fresh research and analysis dated September 11, 2025. Back then, the share price stood at $170.48.
We'll be zeroing in on the business's fundamentals, management strategy, its financial health, all while navigating some pretty intense regulatory scrutiny. But before we jump right in, a quick note. This deep dive, like many others, is powered by the insights from Stock Analytics AI. If you like what you hear and want priority access to deep dives on S&P 500 stocks, you can subscribe to their YouTube channel. It's just $4.99 a month. You can even suggest tickers for future videos, which is pretty cool. Or if you just want a one-off deep dive on a specific company, you can drop them a super thanks.
Part 1.
Business analysis.
Okay, let's start with what truly sets Live Nation apart. They call it their flywheel, a self-reinforcing ecosystem. It's an incredibly powerful concept, isn't it? They don't just participate in the live event world. They seem to dominate it, capturing value at almost every single stage. How exactly does this integrated model give them such an edge?
Well, it's really all about control. You
Yeah.
know, Live Nation controls the content, artists and their tours, the distribution, primarily through Ticketmaster, which everyone knows,
Yep.
and the physical locations, their huge network of venues. The synergy creates a kind of closed loop. It makes it exceptionally difficult for any competitor to really penetrate. Think of it as a one-stop shop for pretty much everything related to a major live event.
Right, a one-stop shop. And the revenue streams clearly show how central this model is. If we look at fiscal year 2024, concert segment is the absolute engine here, right?
Yeah.
A massive 82% of their $19.0 billion revenue. And that's not just promoting shows, it's direct ticket sales, plus all that high margin stuff, food, drinks, merch, even parking.
Exactly. The ancillary revenue is key. Then you've got ticketing, which generated 13% of revenue, about $3.0 billion. This is Ticketmaster. And it's not just selling tickets for Live Nation's own events, but also for a huge number of third-party clients, sports leagues, theaters, you name it. It's a highly profitable segment and technologically really crucial for the whole operation.
And finally, sponsorship and advertising. Only 5% of revenue, you said, but actually their highest margin segment.
That's right. It might seem small percentage-wise, but the margins are fat. This is where they monetize that massive audience they gather. They create strategic partnerships with corporate brands for everything from, on-site marketing and digital ads to those big venue naming rights deals.
So this integrated model translates into a pretty comprehensive suite of products and services then.
Absolutely.
Yeah.
Beyond Live Nation concerts themselves, over 54,000 events in 2024 alone. Ticketmaster offers primary sales, sure, but also a secondary resale marketplace and even venue management software. Then there's Venue Nation with nearly 400 owned or operated venues globally, and Live Nation media and sponsorship, giving brands access to, 151 million fans in 2024 for targeted campaigns.
The scale is just, wow, 151 million fans, 54,000 events across 51 countries in 2024. And for Ticketmaster, the U.S., we're talking an estimated 60–70% market share for primary ticketing at major venues. When you compare Live Nation's roughly 50% global ticket sales share to AEG's, which is under 20%, it's unambiguous leadership.
It really is. And this dominance provides immense value to basically everyone involved. For artists, it's that unparalleled one-stop shop for global touring, guaranteed venue access, massive audience reach that's critical for their main income source. For fans, despite the criticisms about fees, and there are many, it is a centralized, trusted platform for tickets. It provides reliability, security, especially for those really high-demand events. Venues, they get access to crucial content. Those exclusive Ticketmaster contracts often mean securing the biggest tours. And sponsors, they get access to a large, captive, and highly engaged audience for experiential marketing right when people are feeling emotional and excited.
So zooming out a bit, What does this mean for the broader live entertainment market? Is it growing?
Oh, definitely. It's projected to hit $535.4 billion in 2025 and growing at a pretty healthy clip, about 5.4% CAGR, compound annual growth rate projected to reach $859 billion by 2034.
And what's fueling that?
A big part is the experience economy, right? Millennials and Gen Z increasingly prioritizing doing things over buying things. And there was that post-pandemic phenomenon some called funflation, people willing to pay higher prices for entertainment. Though we are starting to see price sensitivity creep back in now. Also, international expansion is key, especially looking at Asia Pacific and Latin America as big growth drivers.
Okay, so a growing market, but who are they actually competing against? You mentioned AEG.
Right. In the grand scheme, it's largely a duopoly with AEG presence. They're formidable, yes, but significantly smaller, under 20% global ticket sales compared to Live Nation's 50%. You have other players, of course, StubHub in the secondary market, Eventbrite focusing more on smaller events. But crucially, no single competitor has really managed to replicate Live Nation's fully integrated global flywheel model at anything close to a comparable scale.
Now, for the critical turn, and this is where it gets really interesting and complicated, the regulatory environment. This seems like the single biggest challenge, doesn't it?
Without a doubt, it's the elephant in the room.
It all goes back to that 2010 merger with Ticketmaster, right?
Yeah.
Approved by the Department of Justice, the DOJ, but under a consent decree to prevent anti-competitive stuff.
Exactly. But then, fast forward to 2019, the DOJ investigated and found repeated violations of that decree. That led to an extended and strengthened decree.
And then came the big one, May 2024, that landmark antitrust lawsuit by the DOJ in 30 states, alleging illegal monopolization, specifically forcing venues into exclusive Ticketmaster contracts.
And the government's stated goal is huge, a structural remedy, which means forcing Live Nation to sell Ticketmaster.
Which would basically break that flywheel model we just talked about. An existential threat, you called it.
It absolutely is. It strikes at the very heart of their integrated strategy.
So this raises an important question. Why don't more companies just compete if it's so dominant?
Well, the barriers to entry are exceptionally high. It's that classic chicken and egg problem. Any new entrant would need to somehow simultaneously secure top artists, get access to enough venues, and build a massive distribution platform all at scale. It's incredibly difficult.
And Live Nation's advantages make it even harder.
Precisely. Their brand strength, Live Nation and Ticketmaster, despite criticism, are seen as legitimate, secure for big events. They have cost advantages, economies of scale from global operations. Powerful network effects fans attract artists, artists attract venues, venues attract fans, creating high switching costs, especially for venues who allegedly fear being shut out of major tours if they don't use Ticketmaster. And then there are the unique assets. The flywheel model itself, that invaluable trove of consumer data, what was it? 331 million fee-bearing tickets processed in 2024. That gives huge insights for marketing and pricing. Plus, there are nearly 400 owned and operated global venues. It's a fortress.
Okay, a quick reminder. If you're finding this deep dive insightful, you'll love the full range of content over on Stock Analytics AI's YouTube channel. Don't forget to like and subscribe. Members get exclusive priority deep dives on all S&P 500 stocks over the next few months.
Management evaluation.
All right, let's shift gears and look at management. We got Michael Rapino, CEO since 2005, the architect of the Ticketmaster merger and this near the $40 billion giant.
Yeah.
And Joe Berchtold, president and CFO since 2021. They've clearly driven aggressive growth, but they've also faced immense scrutiny. How do you assess their handling of these high-stakes situations? I'm thinking, the Astroworld tragedy and, of course, the current legal battle. What about their credibility?
It's a bit of a mixed picture, honestly. The 2021 Astroworld tragedy was a terrible event, a major operational and reputational crisis. Management expressed being heartbroken, they offered refunds, provided aid, but it also highlighted a broader history of safety issues and violations at their events. Then, with the current DOJ lawsuit, management has mounted a very staunch defense. CFO Joe Berchtold publicly said the lawsuit fundamentally misunderstands the dynamics of the industry, claiming it's the venues that drive exclusivity, not Live Nation forcing them.
So that creates a bit of a credibility gap, doesn't it, between that defense and the DOJ's claims of past consent decree violations?
It does. It suggests a real tension between their public posture and the legal challenges documented by the DOJ.
So while they make their formal SEC disclosures, their communication transparency, and maybe more importantly, their ethical reputation seem to face significant challenges, especially in the public eye.
Precisely. Live Nation's reputation among many consumers and lawmakers is, well, it's significantly challenged. You constantly hear accusations of anti-competitive practices, those exorbitant and non-transparent junk fees, and lingering safety concerns. The DOJ lawsuit really connects directly to this perceived lack of business ethics, which kind of contrasts with the company's formal code of conduct they publish.
Okay, let's talk about capital allocation. Management's strategy seems crystal clear. Plow money back into the flywheel. Aggressively. They've planned, what, $900 million to $1.0 billion in CapEx for FY 2025, with a huge chunk, $700 to $800 million, specifically for venue development and refurbishment, aiming for really high returns over 20% IRRs. That seems like a bold double-down strategy, doesn't it? Especially given the legal cloud.
It absolutely is a bold bet. The risk is high, as you say. If they win in court, maybe this cements their dominance even further. But if they lose, if they're forced to break up Ticketmaster, well, that capital could end up stranded in assets that are suddenly much less strategic or just lower return. And historically, M&A, buying up regional promoters and festivals has been a cornerstone of their growth strategy, too. They keep feeding the machine.
So for shareholders looking for direct returns, it sounds like they shouldn't hold their breath. No dividends, a 0% yield, no significant share buybacks.
That's right. It's purely a reinvestment story, not an income one, which isn't necessarily bad for a growth company, but the effectiveness of that reinvestment is crucial.
Which brings us to ROIC, return on invested capital.
Exactly. That's the key metric here. How efficiently are they actually using shareholder money to generate profits? Their trailing 12 months, or TTM, ROIC is around 13.55%, according to Morningstar data. Now, we compare that to their estimated weighted average cost of capital, their WACC basically, what it costs them to fund operations, which is estimated around 10.59%. So 13.55% is above 10.59%, which is good. It means they're creating value. But some other estimates put ROIC lower, maybe even below the WACC. It raises an important question about whether all this aggressive spending is truly generating returns consistently above their cost of capital, especially with the big legal uncertainties factoring into that risk profile. It's critical that new investments clear that hurdle.
Financial analysis.
Okay, let's dive into the core financials now. Live Nation has a market cap around $39.97 billion, so definitely a large cap stock.
And zooming out to their broader financial health, their revenue story is quite dramatic, particularly that post-COVID recovery. Remember, revenue plummeted to just under $2 billion in 2020. Then it just surged incredibly, a real V-shaped recovery, hitting over $23 billion by 2024. The TTM, trailing 12 months ending June 30, 2025, shows $23.72 billion. So huge resilience shown there, but also maybe a return to a more mature growth profile now. That massive post-pandemic surge seems to be leveling off.
Right, they bring in a lot of money, but how much do they actually keep? You mentioned thin margins earlier.
Yeah, relatively thin. If you look at TTM figures again, gross profit margin is around 25.2%. Operating profit margin is only 4.59%. And net profit margin is even tighter, just 2.3%. It highlights how narrow those margins are and how sensitive the bottom line is to swings in revenue or costs.
What about free cash flow generation? That's the cash left after running the business and investing, right?
Correct. And the trend here is pretty significant. FCF was strong in 2021, $1.63 billion. But then it declined, down to $29.3 billion in 2023. That was driven mainly by working capital changes and that big increase in CapEx for venue development we discussed. For the TTM ending Q2 2025, they recovered a bit to $1.13 billion. But that downward trend during a period of massive revenue growth is, well, it's a significant point of analysis. It suggests that despite growing the top line like crazy, they might have struggled to efficiently convert that revenue into deployable cash, maybe due to the heavy reinvestment, maybe operational efficiency, maybe both.
And when we look at their history of actual profitability, their net income, that's a bit spotty, isn't it? A concern for value investors, perhaps.
It is. True. Consistent profitability, after years of losses or near break-even, really only showed up reliably during that post-pandemic boom from 2022 to 2024. Before that, net losses from 2015 to 2018, near break-even in 2019, then huge losses in 2020, 2021 because of the pandemic. This pattern kind of suggests that consistent net income requires immense scale and maybe lacks resilience if there's a significant economic downturn.
Okay, shifting to the balance sheet. Leverage. Their debt-to-equity ratio as of Q2 2025 is high, right? 280.9% or 2.81. How concerning is that level of debt?
Well, the ratio is high, no doubt, but context is crucial here. Firstly, it has improved significantly from its peak, which was way up at 484.4%. More importantly, though, the company holds a very strong cash position, $7.1 billion in cash and short-term investments. That actually exceeds their total debt at $6.5 billion. So despite the high DE ratio on paper, there's no immediate solvency crisis. They have plenty of cash to cover their debt obligations right now.
And short-term liquidity. The current ratio was 0.88 in Q2 2025. Usually you want that above 1.0, right?
Normally, yes. A ratio below 1.0 often signals potential short-term liquidity issues for most companies. But for Live Nation, it's less concerning. Why? Because a large chunk of their current liabilities is deferred revenue. That's cash they've already collected for tickets to future events that haven't happened yet. It's technically a liability on the books, but it's not a traditional cash outflow liability because the cash is already in the bank. So that 0.88 doesn't look as risky as it might elsewhere.
Okay, now for maybe the crux of the matter for potential investors, valuation. You mentioned Live Nation trades at a significant premium.
Oh, absolutely. The current trailing 12 months price-to-earnings ratio, the PE, is hovering around 74.0, sometimes even higher. To put that in perspective, look at peers like Disney PE around 19.7, Comcast PE around 7.6. You just can't explain a PE of 74 by their recent growth alone. It strongly suggests the market is baking in a substantial monopoly premium, pricing the stock as if their dominance will continue unchallenged forever.
Which leads us to intrinsic value. The discounted cash flow, or DCF, model cornerstone of the Warren Buffett philosophy, focusing on long-term future cash flows. What does a conservative DCF model suggest here?
Right, so an educational DCF model was put together using reasonably conservative assumptions, and it revealed an estimated intrinsic value range for Live Nation of $115 to $145 per share.
Okay, $115 to $145 compared to the $170.48 price when this analysis was done. That's a big gap.
It is. This valuation range strongly suggests that the stock is trading at a significant premium to the present value of its conservatively projected future cash flows.
And what were the key assumptions baked into that DCF model?
Pretty standard conservative stuff. A 10-year forecast plus a terminal value. Assume 5% annual revenue growth for the first 5 years, then slowing to 2.5% long-term. An average free cash flow margin of 5%. And importantly, a discount rate, a WACC, of 9.5%. That was chosen specifically to reflect the risk profile, most importantly, the significant and quantifiable risk posed by that ongoing DOJ antitrust litigation.
All right, let's move into part 2, starting with market sentiment.
Market sentiment.
So, with all this background, the strong business, the regulatory threat, the valuation premium, how does Wall Street actually feel about Live Nation right now?
Well, the consensus from professional analysts is overwhelmingly positive, interestingly enough. We're looking at a strong buy rating overall. The average one-year price target is around $174, with the range going from about $133 on the low end up to $205 on the high end. Citi even recently raised its target to $195. So this bullish sentiment implies that the professional investment community generally believes Live Nation's fundamental strengths, that flywheel, will ultimately outweigh the risks posed by the DOJ lawsuit. They're betting on the company navigating through it.
For the public conversation, the general media tone, that's quite different, isn't it? Seems sharply divided.
That's absolutely right. It creates this fascinating split public image. On one side, you have investors and the financial press focusing on strong earnings, big tour announcements, expansion outgrowth Relations Foods. On the other side, you have much of the mainstream media and many consumers focusing on the DOJ antitrust suit, talking about monopoly power, those inflated junk fees, stifling competition, often amplified whenever there's a big ticketing issue, like for a major tour. So yeah, simultaneously seen as a juggernaut by investors and, well, a predatory monopolist by many of its customers and critics.
What about market indicators that signal skepticism? Short interest, for example.
Yes. Short interest is a crucial one here. And for Live Nation, it's notably high. We're talking 19.83 million shares sold short. That represents 12.77% of the public float the shares available for trading. Anything above 10% is generally considered high and indicates a significant, well-capitalized group of investors betting against the stock, betting the price will decline. The likely drivers. That DOJ lawsuit, uncertainty, and the demanding valuation we just discussed.
And yet, the actual stock price, the technicals, tell a very different story right now, don't they?
They really do. From a pure technical perspective, the stock's price action is unambiguously bullish at the moment of this analysis. The share price, $170.48, is significantly above both its 50-day simple moving average, or SMA, which was $154.87, and its 200-day SMA, which was $141.16. Those moving averages smooth out price trends. Being well above both indicates strong short-term and long-term positive momentum. It suggests the bullish narrative, despite the risks and high short interest, is currently winning the battle in the market.
Ownership structure.
Okay, let's look inside. Who actually owns this entertainment giant?
Ownership is highly concentrated among institutional investors. There are about 1,537 institutions holding over 223 million shares. But the really key player, the largest and most important shareholder by far, is Liberty Media Corporation. They hold roughly a 29.8% stake. That gives them de facto control and immense influence over the company's direction. Other top holders are the usual big names: Vanguard, BlackRock with about 5.1%, State Street with 4.7%. Interestingly, you also see some respected value-oriented firms like Vulcan Value Partners and Ecker Capital Management among the holders. That suggests some fundamental investors do see long-term value here, despite the obvious risks and valuation concerns.
So if the big institutions in Liberty Media hold so much, what about the insiders, the people who know the company best, the execs, the directors? What are they doing with their shares?
That's another interesting piece of the puzzle. Insider activity over the last 12 months leading up to this analysis has been heavily skewed towards selling. There was a net disposition, meaning more selling than buying, of 825,302 shares. That's about 916,000 shares sold versus only about 90,000 bought. CEO Michael Rapino and CFO Joe Berchtold have been consistent sellers during this period. Now, to be fair, a lot of these sales are listed as non-open market dispositions, often related to covering tax liabilities from stock compensation vesting. That's normal. But what's notable is the absence of any significant discretionary open market purchases by top executives. At these valuation levels, it seems leadership might not view the stock as deeply undervalued right now. That said, CEO Rapino still holds a very significant stake, around 4.3 million shares, so he still has plenty of skin in the game.
So summarizing the ownership picture, highly concentrated. Liberty Media plus the top institutions likely control the majority. The company's fate really rests in the hands of a relatively small number of large, sophisticated investors.
Risk assessment.
Okay, let's pull the risks together formally. Let's unpack this with a classic SWOT analysis. Strengths, weaknesses, opportunities, and threats for Live Nation. What are the core strengths?
The strengths are clear and powerful, dominant market leadership first and foremost. That integrated flywheel business model with its strong network effects and really high barriers to entry, unmatched global scale and reach, exclusive content deals, and that huge venue network. And despite everything, strong brand recognition for both Live Nation and Ticketmaster.
But even a giant like this has its Achilles heel, right? What are the key weaknesses?
Absolutely. High financial leverage is one. That 2.81 debt-to-equity ratio, even with the cash buffer, is still high. Then there's the negative public perception, the fees, customer service complaints, those anti-competitive claims. Operational and safety risks are always present, as sadly highlighted by Astroworld, and a significant profitability dependence on the Ticketmaster segment, the very segment under regulatory fire.
Okay, looking forward then. Where are the opportunities for Live Nation to grow further?
Plenty of opportunities still. International market expansion is a big one, especially untapped potential in Asia and Latin America. Increasing per-fan monetization, think more premium seating, VIP packages, dynamic pricing, technological advancement, using AI for smarter pricing, better data analytics for targeted marketing, and potentially diversifying into other live entertainment verticals beyond music.
All right, now for the big one, the threats. What keeps Live Nation's leadership and probably its investors up at night?
Number one, with a bullet, is the DOJ antitrust lawsuit. We've hammered this point, but it has to be repeated. It's the most severe, immediate threat. An existential risk that could lead to a forced breakup and shatter the core business model. Beyond that, an economic downturn is always a threat. Live events are highly discretionary purchases. Recessions, reduced consumer spending that could hit demand hard.
This raises an important question about the wider economic currents. How do specific macroeconomic factors play into this? Inflation, interest rates?
Yeah, those are major headwinds. Inflation is a double whammy. It eats away at consumer purchasing power, making those already high-ticket prices feel even steeper. And it increases operating costs for Live Nation artist fees, transportation, labor, venue costs, everything goes up. Despite that funflation trend we saw, persistent high inflation could really test consumers' willingness to pay premium prices for live events. Rising interest rates also bite. They increase the cost of servicing Live Nation's substantial debt. That Q2 2025 interest expense expense was over $72 million. It also makes future borrowing or refinancing more expensive. Now, they do have over 90% of their debt at fixed rates, which helps mitigate the immediate impact, but it's a long-term pressure point.
And what about the global stage? Any specific geopolitical factors like those U.S.-imposed tariffs mentioned for 2025, could they have an impact?
The impact there is likely more indirect, but still present. Tariffs could increase the cost of imported production equipment, fancy lighting rigs, sound systems needed for big tours. It could also raise international shipping and logistics costs, making global touring more expensive. There's also a more remote but potentially high-impact risk of tariffs being applied to services. If that happened, it could disrupt cross-border data flows, which would be a big problem for Ticketmaster's global operations. Less likely, maybe, but a risk to consider.
Conclusion.
Okay, let's synthesize all of this. Let's start by looking at the strongest arguments in favor of Live Nation, the bull case.
All right, the bull case rests squarely on Live Nation being the undisputed global leader in a large and growing industry, the experience economy. That trend is powerful. Their integrated flywheel model is a formidable competitive moat built on scale, network effects, high barriers to entry, hard to attack. There are clear opportunities for further growth, both internationally and by squeezing more revenue per fan. And they're led by a seasoned management team with a proven track record of, well, aggressive growth.
Okay, sounds compelling, but if we connect this to the bigger picture, the bear case is equally compelling and maybe arguably more pressing right now.
I think that's fair to say. The bear case is dominated by that huge existential regulatory threat. The DOJ lawsuit seeking to break up the company by forcing the sale of Ticketmaster, that would just shatter the flywheel. This massive risk is coupled with a really demanding valuation. That PE ratio, over 70s, basically prices in continued unchallenged dominance, leaving little or no margin of safety for investors if things go wrong. Add to that the high leverage, the relatively thin net margins, the historically inconsistent profitability, the vulnerability to economic downturns, and that significant short interest betting against the stock. Yeah, it's a very challenging picture from the bear perspective.
What's really fascinating here, and maybe the key takeaway, is the sheer difference between how the market currently values Live Nation and what our fundamental analysis suggested. Just to reiterate, that estimated intrinsic value range from the DCF model was $115 to $145 per share.
Right. And as of our analysis date, Live Nation's share price was $170.48, trading at a significant premium to that intrinsic value range. This raises a really important question for you, the investor. Are you comfortable paying a price that seems to assume Live Nation's market dominance continues completely unchallenged by regulators? The profound legal uncertainty surrounding the DOJ case, combined with this clear valuation disconnect, strongly suggests that a significant margin of safety is simply absent at current levels. The risk-reward seems skewed to the downside based on this fundamental analysis.
So here's something for you to mull over as we wrap up. In this ongoing battle for the future of live entertainment, is the market currently betting that the power of the experience economy will ultimately triumph over these significant regulatory challenges? Or, conversely, are regulators actually on the cusp of fundamentally rewriting the rules of the game for this industry? And maybe more pointedly, how much is too much to pay for an unrepeatable live experience when the company delivering it might be facing its own potentially unrepeatable moment of reckoning? That wraps up our deep dive into Live Nation Entertainment. If you've enjoyed this in-depth analysis and want to unlock more insights like this, make sure to like this video and subscribe to the Stock Analytics AI YouTube channel. Remember, for just $4.99 a month, members get priority deep dives on all S&P 500 stocks. We're covering them all over the next few months. Plus, you can suggest tickers you want us to cover in the comments. And if you want a one-off deep dive on a particular stock, you can request that with a super thanks. Before you go, please remember, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.